Jordan is a guy who I've known for a long time. Interestingly enough, we are both very avid Husky football fans, and even though there's about 40 years difference in our ages, we grew up within, I would say, probably a mile of each other in the Lawhurst area of Seattle. Jordan, you're the technical guru when it comes to precious metals and other things, but let's talk a little bit about gold. Gold right now is up $7.80 at $1276.40. I know you're very bullish long term. You and I chatted up at the conference in Vancouver here a couple of weeks ago. What's it going to take to really get us into an acknowledged bull market in terms of gold in your mind?
Well, that's a great question, Al, because I mean, it can be semantics, which as far as how people look at that. And I mean, it's a very interesting question because I've kind of been terming myself the bearish bull. I mean, if you look at, not to get away from gold, but if you look at the stocks, everything was completely bombed out at the end of 2015, and fundamentals have gotten better. Companies are raising lots of money. And even if metals prices were to come back down somewhat significantly, the industry is in much better shape now than compared to a couple years ago. So I think that low that we had for gold at 1050 or 1045 at the tail end of 2015 is extremely significant. So I don't see gold going lower than that. However, looking at the chart, I am concerned that we could see a move lower later this year before we see a big move higher next year. But I'm kind of drifting along here. But as far as your question, I really think we need to see weakness in the stock market and weakness in the economy. I mean, I hate to say that. As a gold bug and a gold bull, I don't want to be rooting for bad things, or I don't want to be rooting for the economy to get into a more difficult spot, even though it hasn't been doing that well, as we all know. But there's been a long-term negative correlation in place since 2011 between essentially gold and the stock market. And we had this, as you know, Al, in the late 90s, and then also we had it in the 70s at times. And so when you have a negative correlation that's been going on for several years between gold and the stock market, that, of course, is negative for gold when the stock market's going up. But then when the stock market rolls over and runs into problems, that's when gold can perform really fantastically. And we saw that a couple times in the 70s and the early 2000s. And we see that set up again where the stock market has continued to make new highs on a longer term basis. Whereas gold, I mean, we do have the peak around 1375 last year, but the rally that we have has not made a higher high yet. And so I just think I'm talking about when gold is really going to take off, when we see gold take out 1350 and break above 1400 and get back to 1550, 1600. I don't see that happening until we see real weakness in the stock market and real weakness in the economy. I think when those things happen, then we know gold is going to be ready for a big move higher. And so that's really what I'm looking for, to answer your question directly.
So Jordan, in all fairness, if we look at the chart for just this year in gold, it's been a very impressive climb, higher lows and higher highs. Again, as you pointed out, we really need to see us get above that $1,300 level in, I think, this current move. But so much is being talked about the Fed meeting this afternoon, and every time the Fed raises rates, gold moves up on the tail end of that. But when you actually look at the data coming into this rate hike, it's different data and recent different action in gold. Can you take us through what your technicals are showing you about this discrepancy this time?
Well, this time, essentially, gold is not as oversold as it was coming into the other rate hikes. Now, going into the last rate hike, which I believe was March, gold wasn't hugely oversold. It was a little oversold there. Gold was more oversold in the two rate hikes before that, the December 16 and December 15 rate hikes. That's when gold was a lot more oversold. But nevertheless, gold still was somewhat oversold going into the March hike. And now it's really, I mean, it's trading around 1270, so it's only about $25 or 2% off its high. So gold is not quite as oversold. And at the time of those other hikes, inflation expectations were rising, and now they're plunging, I could say. So it's possible gold could pop here and maybe retest 1300 again, but I think it's very unlikely that we see gold continue to rise and go above 1300 after this hike. I mean, even though it is bullish if the Fed turns a very dovish here, and this is the last hike for a while, or at least for the next couple months. I mean, that is bullish for gold, but still the market, I think, in the last month or two has kind of been pricing in a dovish hike, so to speak, and the fact that maybe the Fed will only hike one more time. I mean, a couple of days ago I checked, and the Fed or the markets were only pricing in a 50% chance of one more hike for the rest of the year. So I mean, the thought that, well, the Fed might not hike for the rest of the year. I mean, remember, Corey, we were talking about that a couple of weeks ago and how that could be really bullish for precious metals. It is, but if we look at the market's only pricing in a 50% chance of one more hike. So that tells us, I mean, there really isn't a whole lot of room there for precious metals to really rally on that news. I mean, if the market was pricing in 100% chance of one more hike for the rest of the year, then there would be some room for, for weak data to push precious metals higher. But where we are here and now, I mean, the expectations are already so favorable for precious metals in that the market's only expecting a 50% chance of one more hike, that if that 50% chance goes down to, 10% or 5%, sure, that should be bullish for precious metals, but I don't think that would be enough to push gold above 1,300 or push the miners that much higher. Sure, the miners they've been lagging, as we know, and they have some room to move, but in the bigger picture, we would just need a much bigger rally in both the miners and gold to really take us, I don't want to say bear market rally, but to really take us through resistance and up close to the 2016 highs. We would need a much bigger move higher than I think is possible right now. I mean, we would need to see some really negative news, an acceleration of the bad news that we've been seeing in the economy. We would really need to see that accelerate and people start talking about a recession at the end of this year.
I have to tell you, Jordan, I've turned into more of a political junkie than anything else of late, and I'm involved in a number of, I would say, for my neighborhood, certainly serious high-level discussions in terms of potential for the future, and I'm under the opinion right now that it could be pretty grim right around the corner, and I say that for the following reasons. Economically, number one, as you mentioned very accurately, the inflation numbers are really not exactly exciting right now, point number one. Point number two, retail sales and other indicators are really pretty weak right now. All it's going to take, I think, for bull market, for lack of better terms, the acknowledged bull market, I would have to say, to happen is, I think, if the president continues to alienate members of Congress, if he continues to even further alienate the public, etc., I think that is going to bode very, very well for the price of gold. And I'm kind of betting on that right now. Any comments?
Yeah, I think that's certainly possible. And then on the other end of that, I'll just mention a couple things, because this does have, I mean, we know that inflation expectations have come down quite a bit. And I think at some point, I mean, if Trump is able to get, obviously the market right now is pricing in very little chance of tax cuts and infrastructure spending. And see, if we can put it together, I mean, you get economic weakness, and then you have, I mean, if you have enough economic weakness, then you have you have some bipartisanship there where people feel that, oh, we need to put something through, because even though I'm a Democrat and I don't like Trump, I'm going to lose my job if the economy keeps getting worse. So if things actually continue to get worse, that could actually give Trump and just the Congress somewhat of an opportunity to actually pass something. And I think if they can pass tax cuts or infrastructure spending, I think initially on that news, you would see precious metals get hit. But longer term, I think those types, I mean, when you have huge infrastructure spending and tax cuts, I mean, those things the initial reaction to that, I think, would be negative for precious metals. But beyond that, I think it would be bullish, because those are the types of things that could raise inflation expectations down the road. And I think globally, I mean, China has their whole one belt, one road thing. And so we know that the economy just globally in the last several years has not been doing well with these rate cuts. And so I think the next cycle is really going to be driven by infrastructure spending, not just in the U.S., but globally. And so I see that as a real driving force for not just gold, but for hard assets in the years ahead. But I think where we are here and now, we're still probably a year away from when those things start to get enacted. So I know I went a little off track with what you were saying, Al, but I mean, I completely agree. I mean, that those things are bullish for gold, but I do think we have to be careful, because because the expectation now is they're not going to pass anything. And that's probably partly why gold is trading near 1,300. But if just things improve a little bit and it seems like they're going to, they might start talking about passing something, I think that initially would be negative for precious metals. But even though ultimately it would be very bullish.
Well, as you said on the onset here, Jordan, that so much depends on what happens in the U.S. equity markets. And so much of the move higher has been due to optimism around Trump, which is now fading. I think quite quickly because nothing has happened, but it's also been continued easy money policies from central banks around the world. And if we see a change in that, then you know what? That could actually start to hurt the markets. But again, if anything comes out of this Trump administration and anything of substance, then that could very well help the markets, which again distracts people from gold. But right now, all eyes are on the Fed. And more importantly, I think all eyes are on this recent rotation that we have seen inside the markets to see if that continues. We'll keep in touch with you, Jordan, and be chatting with you next week. So thanks for your time again.
Thanks for having me.